We are heading towards another quarterly loss. Live from New York City this morning. Good morning, good morning. Your equity market trying to squeeze out some gains. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, we begin with the big issue, wrapping up a messy Q3.
The third quarter.
There's been no place to hide.
Stocks keep going down. It's painful and horrible.
We have had 10-year Treasury yields break 4%.
Global markets moving 20, 30, 50 basis points off of one data point or one policy announcement.
Whether it's fixed income, equities, commodities, currencies.
Everywhere is a pain trade at the moment.
The rates seem to be driving the bus.
That is driving sentiment. That is driving equity markets.
The dollar's a challenge. In addition to this surge in real rates,
it's been a pretty volatile time.
There's really no case for equities.
We're bracing for some pre-announcements and earnings cuts.
This is a hard market,
so we'll see.
Joining us now is Mohammed Al-Erin of Bloomberg Opinion and Queen's College, Cambridge. Mohammed, allow me to bring you some headlines from the Fed Vice Chair, Lael Brainerd, saying the following. We should consider spillovers as rates tighten globally. Goes on to say the Fed policy needs to be restrictive for some time and that the Fed is committed to avoid pulling back prematurely. Mohammed, your thoughts on those headlines this morning?
John, they highlight this tension we're seeing within the UK now between the US and the rest of the world, which is how do you reconcile the need to tighten monetary policy with the need to maintain financial stability? And that tension is playing out not just at the domestic level, but at the international level.
Mohammed, you framed it perfectly earlier this week. Can you address inflation and preserve financial stability simultaneously? Does something have to give?
Not at the domestic level. If you're well coordinated at the domestic level, which is a big if, but if you're well coordinated, you should be able to reconcile it. At the global level, it's a real problem. John, you know, it's really important to step back and ask yourself, what has this week told us? It's been very sobering and we all feel exhausted. But we learned a lot. We learned that you can get a major policy slippage in the G7 countries with mature institutions. We've learned that liquidity can evaporate in mature markets just like that. We've learned that the most boring element of the non-banks can be a systemic risk. We've learned today inflation is still a problem in Europe and the US. And the last issue is what you just raised, this tension between monetary policy and financial stability. You know, we need to absorb this. I think this week has told us a lot about where all these transitions going on and suggests that the next few weeks are going to be pretty volatile.
Mohammed, allow me to step back even further and go back to something you said maybe 6 to 9 months ago. You said it might be a choice between recession or high inflation for longer. Is it now a choice between recession and financial instability or higher inflation for longer?
So that's an important addition. I think for certain countries, especially those who are importing the U.S. monetary policy but do not have anywhere near the robustness of the U.S., that's a real issue. Yeah, and we've got to somehow figure out how to go through this. John, you and I know that we tend to focus on interest rate risk, particularly what the Fed's going to do, and on credit risk, economic conditions, etc. We tend to ignore liquidity risk, and that is something that we need to pay a lot more attention to.
Well, we've been paying attention to that in the UK in a major way this week. Mohammed, we've seen the Bank of England driven to intervene at the long end of the gilt market. We saw the BOJ in the last week have to come in and step into the FX market, support the Japanese yen. The ECB, before any of this, had to set up an instrument to get ready to put a lid on Italian yields as they set to raise rates even further. China's been warning investors that they're willing to step in. Mohammed, we talked about this earlier this week. Who's next? Who's willing to blink? And can we get to that equilibrium, that new equilibrium, without central bank intervention every step of the way?
That's the major question. And these interventions, to be clear, are temporary. I think you used the word Band-Aid. We call it plaster here in John, but these are just Band-Aids. And it tells you that the global economy is not clearing on its own, or if it's allowed to clear on its own, there's going to be a lot of collateral damage. You know my view, when you distort an economy for so long, getting out of the distortion is by definition problematic. And that is what we're learning. But we have no choice to get out of the distortion, because if we don't, the inflation issue is going to be even more problematic. I think you and I have been warning people, all of you who are looking for a pivot, be careful what you wish for, because this pivot only happens if you have an economic accident or a financial accident. And the journey to an economic and financial accident is a very painful journey.
Two things, Mohammed. One, I've lived here too long. It's Band-Aid now and not plaster. It's like a role reversal with you in England and me here in New York. Two, I remember when I pushed you for a conclusion, you said the risk might be we might have to accept inflation for longer. Do you sense that shifting now somewhat, Mohammed? Are you focused more on the pain that we've got to go through to get inflation lower?
Not yet, John. Not yet. We're not there yet. I think we need to, central banks need to experience a lot more pain in order for them to settle for a significantly higher inflation target. Remember, that would be a significant blow to central bank credibility. And central bank credibility is not strong right now. So it will, unfortunately, I say this unfortunately because these are livelihoods at stake. Unfortunately, it has to be more pain before we get to a world in which central banks say we are changing our inflation target. Now, you can justify changing the inflation target because the economy is going through such structural change that you need more lubrication in the system. So there is a justification for changing your inflation target, an economic justification, but the credibility blow would be significant.
Let's just stay on credibility this week. Was this week a blow for central bank credibility at the Bank of England? And allow me to frame why, Mohammed. The concept of fiscal dominance has become much more prominent this week in conversations I've had. Just the idea that the Bank of England will have to spend too much time supporting what the government is doing, that it will take its eye off the ball when it comes to its mandate. Do you think they've contributed to that perceived fiscal dominance this week, just by the way they've been very close to what the government has been up to, what the Bank of England has been up to through much of the last few days?
So I've had that argument, John, and honestly, I don't understand it. The dramatic 11 a.m. intervention was a financial stability intervention. We came this close to a financial accident in the UK, and that financial accident would have caused a general deleveraging of balance sheet and massive contagion in the financial markets. So the fact that the Bank of England intervened in the middle of a trading session, you know, and I know they prefer waiting for a weekend when they can explain everything, or wait till after trading hours so they can explain. They just acted in a very bold fashion because there was a financial stability crisis facing them. That is what that was. This wasn't about fiscal dominance. This was about cleaning up or avoiding further damage to livelihoods. So I don't understand that criticism of the Bank of England, to tell you the truth. Now, where we're going to have a discussion is come November 3rd, have they acted in intra-meeting or not? As you know, I think they should. And if they haven't, do they have the courage to do 100 to 125 basis points on November 3rd? Then we will test that hypothesis.
I wonder if we had that conversation before then, Mohammed. How much of a cliff edge is there on October 14th when that special guild operation is set to expire?
They can extend it. I think that is a very soft deadline. They can extend it. They have to worry about what they're doing to the curve. Again, something that more people should be focusing on, because they are distorting the curve. But they can extend it, John.
Do you think they will extend it?
Depends what the government does. You know, this morning, early morning in the UK, there was a lot of optimism that the meeting with the Office of Budgetary Responsibility would be the context for revisiting just one element of the package. You know, to be clear, what's being questioned is not the structural reforms. what's being questioned is not the energy stabilization. It is just the magnitude, timing, and sequencing of these large tax cuts. And the hope was that this meeting with the OBR would provide the context, as you know, to just say we're gonna do that later. Well, it didn't happen. So that puts the rest of the policymaking community in a really difficult situation.
Mohammed, you've said 125 from the ECB, from the Bank of England rather, potentially on November 3rd. I squeezed this question in earlier this week. Given how things have played out over the last couple of days, do you think they can wait until November 3rd?
I don't. I understand that caution, John. This is all judgment.
Sure.
Type 1, type 2 error. I understand that caution. And that there's also, you don't want the spotlight to shine on you, especially given what's happening to the mortgage market. There's a lot of pain in the mortgage market right now. People who simply can't get mortgages. Products have been withdrawn. It's a total mess. So I can understand why they would rather be cautious on that. But I do think that the longer they wait, the more they're going to have to do. One final question, and this is a big call, and it's kind of crystal ball type stuff. I just want to understand your feel for things right now. Do you think by the time we start 2023, do you think this Federal Reserve is still doing QT? That's a great question. I suspect they probably will be, but I don't have a high level of conviction on that call. That's the one I'm trying to look out for. Mohammed, you've been phenomenal this week. Thanks for being with us. We really appreciate it. Good friend of mine, good friend of this program, Mohammed Al-Arian, and what's been happening in the UK and for global central banks as well. Keeping up with this market, I've said it all morning, all week, all month. You've still got another quarter of this, less than 7 hours remaining in a messy third quarter, and then you've got another 3 months. Kaylee Lyons has more. Hey, Kaylee.
Hey, John. Yeah, I can't decide if I feel like the third quarter lasted 5 minutes or 5 years because so much has happened. Where we are looking like we're going to end at the end of the quarter is down on the S&P 500 for a third quarter in a row. That is the longest streak of quarterly losses going back to 2009, with the losses this quarter to the tune of more than 3%. At the same time, we've seen massive moves in the bond market, up more than 100 basis points on the 2-year Treasury yield, 122 to be exact. That is the second time in 3 quarters we have seen a move of a full point or greater. Then, of course, there's been big moves in commodities moving to the downside. WTI down 24%, back down to $80 a barrel. And then amid all that selling pressure across those 3 asset classes, one stands out to me, Bitcoin up 2.8%. I'm just going to leave that there. Then to get back to the equity story, I want to note that it's really not just about the end of the quarter number, because we have been on a roller coaster ride over the last 3 months. At one point, we were up 14% on the S&P 500 as it rallied from June to mid-August. Then it reversed even harder with a 16% drawdown from that peak. That is the biggest drawdown from a quarter high on record. And this will mark the first time since 1927 that the benchmark is closing a quarter with a negative return after earlier rising more than 10%. Finally, the asset class I haven't mentioned yet would be currencies. We have to talk about the strength of the dollar, and I'm not really sure if I need to say more than just showing you the WCRS function on the Bloomberg terminal, which shows how currencies around the world have performed against the US dollar. Everything on the screen is red as the greenback has had its best quarter since 2016. It's the dollar's world, John, and everybody else is just forced to live in it.
They're suffering in it, that's for sure. Kaylee Lyons, that stat on the turnaround in the last quarter is phenomenal. Kaylee, thank you. Coming up, Meta joining a growing list of companies slamming the brakes on hiring.
The labor market with our suppliers, we're seeing absenteeism that interrupts our supply chain. The inflation's hitting all of us in all parts of our business.
And that conversation up next with Morgan Stanley's Matt Hornbeck.
The labor market with our suppliers, we're seeing absenteeism that interrupts our supply chain. We're seeing a lot of input costs coming in for premium shipping and parts. So it's really the input costs are going up. The inflation's hitting all of us in all parts of our business.
That was the Ford boss, Jim Farley. Meta joining Ford along with a host of other companies hit by rising prices. Meta initiating a hiring freeze with plans to restructure and reduce headcount for the first time ever. The chief, Mark Zuckerberg, saying in remarks obtained by Bloomberg, quote, "I had hoped the economy would have more clearly stabilized by now, but from what we're seeing, it doesn't yet seem like it has. So we want to plan somewhat conservatively." For more, let's get to Ed Ludlow here in New York. Morning, Ed.
Morning, John. This was part of a weekly Q&A that Zuckerberg holds with Meta employees and how hope fades, right? This is a company that in its near 20-year history has never reduced headcount. Yes, these are not layoffs, but what Zuckerberg told employees were where people leave, they will not backfill. They will really increase scrutiny on performance-based reviews, and if you don't step up, then you're out. This is what we're talking about here. And what I find staggering is in the most recent quarter, this is a company that had 80,000 global employees but added 5,800 new workers, and how quickly things have changed. It's about advertising, right? You look at the macro picture and what Meta's dealing with. Ad prices have come down significantly. They are pivoting to video to compete with the likes of TikTok and YouTube. Well, video carries less revenue in the ad space because you have to share that revenue with creators. And they have Reality Labs, this future proofing unit that's losing $3 billion a quarter. Something had to give at some point. But again, this was part of a 2023 budget review. The macro conditions are not what the company hoped, and they're making significant changes. And let's just bring up the long list of names. And this is a long list of names across corporate America that are either freezing hiring or making active reductions in headcount. This is not just technology, although you look at some of those names, they are those that are coming out of the pandemic era, former darlings into now out of favor tech products, but also broader. I'm talking, of course, about the automakers and Walmart as well, John.
Ed, thank you, buddy. Hiring freezes. That's the phrase there. It's important. Let's sit on that. Morgan Stanley's Matt Hornback joins us right now. Matt, can you fire what you can't hire?
John, thanks for having me on the program again. And I think that's a great question. That's exactly the point here, is that if you're sitting there in the C-suite and you're looking at reducing your labor force, you have to be really confident that you're not going to need them back in 6 months. Because if you do, you're going to have trouble finding them probably, but you're also going to have to pay up for them. And that's a really difficult decision, I think, for the C-suite to make these days. So you really have to become pretty pessimistic about the outlook. And that's where I think the equity market plays a big role, John.
So, Matt, this is something RBC said, connected to where this conversation is going. We have said that job losses, when they materialise, are likely to be relatively modest. But what if earnings get really dinged up here on the fact that the volume of spending is declining and maybe gets worse as central banks around the world slam on the brakes? Matt, are you saying we should pay more attention to what is happening with earnings, to what is happening with stocks, than what is happening for the labour market? Should the Fed be paying more attention to just that?
Absolutely. I mean, our chief equity strategist, Mike Wilson, has been flagging corporate earnings and the downside risks to them for quite some time now. That's exactly what we're thinking, John, is that the equity market probably has further to go down. That should have a negative influence on CEO confidence. You know, CEOs and small business owners should probably become more pessimistic about the outlook. And then that will translate into either more hiring freezes, a beginning of a layoff cycle. And that's ultimately what needs to happen to this economy in order to slow down demand. I mean, John, the PCE inflation report that we got this morning was another upside surprise.
Yep.
That's on the back of an upside surprise to CPI. So we're getting strong inflationary pressures coming through from the demand side here, John. This is less a supply story these days. It's more of a demand story in the United States.
I can count 9 consecutive weeks now of 10-year yields climbing, just about again this week as well. Matt, from a growth perspective, this bond market is screaming for lower yields, and we're not getting them in a massive way, Matt. Why is that?
Well, I mean, John, what's going on in the bond market really comes down to this dichotomy between understanding that the Fed probably has more to do raising interest rates, tightening financial conditions, but then what we have going on outside of the United States, the energy crisis in Europe, the slowdown that we're seeing in China, these factors tend to weigh on the long end of the yield curve. So we've gotten a tremendous flattening in the term structure of interest rates in the United States. We at Morgan Stanley think that there's more to go there. So the curve is really telling you quite a lot about what's going on in the world today.
Where does that leave the dollar call, Matt? Because you guys have been big dollar bulls.
Absolutely, John, and we're still dollar bulls. We think that the dollar has further to go into the end of the year where we see it topping out. You know, we don't think the dollar goes up forever, of course, but you can clearly see in the global growth differentials, the monetary policy divergence that we're seeing between the U.S. and Japan, most notably. You know, these are types of factors, John, that keep the dollar moving higher in our view. It's not forever, but nothing is forever. We think the dollar tops out later this year, but we're still dollar bulls.
Matt, what's the circuit breaker for that? What leads to that dollar top?
John, I think it could be a variety of things. You know, obviously, sentiment is key here. Sentiment is going to probably worsen as we get closer to the month of January, which is historically the coldest month in Europe. There's a lot of concern around just how bad the winter in Europe is going to be, what that is going to mean for the demand side of the energy complex. There's a lot of uncertainty around that, John. I mean, I don't believe what the weatherman tells me about the weather tomorrow, let alone how cold Europe will be in January.
I'm with you.
I think once we get closer to that period of time, John, there will be a sentiment shift making our way into 2023.
Matt, can you leave us with a number? Dollar yen 144. Euro dollar right now, 97.35. What are you looking for year end?
So we're looking for 150 on dollar yen, John. And then on euro dollar, we have a 93 target at this point.
There we go. Matt, it's been too long. Don't be a stranger. It's good to see you. Matt Horn back there of Morgan Stanley. Thank you, sir. Coming up, the morning calls and later, the warnings from corporate America piling up. Bank of America's Jill Carey-Hall, Evercore's Julian Emmanuel, both joining us around the open and bound. Really looking forward to that conversation. As we count you down towards the open, 7 minutes away, equities declining just a touch. We're down 0.2% on the S&P. Live from New York, this is Bloomberg. Katie said it, we're staring down the barrel of another quarterly decline on the S&P 500, the longest quarterly losing streak going all the way back to 2009. Futures right now down about 0.2% on the S&P, and the Nasdaq down by 1/3%. That's the equity story. Here's the bond market picture. Just about ready to squeeze out another week of gains on a 10-year yield. 9 consecutive weeks of it. Yields in today by 7 basis points on a 10-year 371. Off the highs of the week so far, north of 4%. That's the price action here in the morning calls. Your first call from KeyBank downgrading JB Hunt to sector weight, saying recent channel checks point to weakening demand. JP Morgan cutting its Alibaba price target at 135, growing concerned about the company's sales outlook due to China headwinds. And finally, Citi cutting its Nike price target to 93, highlighting a challenging backdrop and continuing supply disruptions. That stock is down by 13% in the pre-market. Up next, investors bracing for earnings season. That conversation with Bank of America's Jill Carey-Hall and Evercore's Julian Emmanuel. The cash open up next. Here we go. Let's get you to the weekend. Live from New York this morning. Good morning. Futures negative just about, down 1/4% on the S&P. On the Nasdaq 100, down 0.4%. On the Russell, the small caps lower by about 1/4%. That's the equity market story on a session. There's your opening bounce. Switch up the board and get to the bond market. Yields lower by 7 or 8 basis points. Your yield 371 on 10s. Euro dollar negative 0.75%. Double-digit CPI in Germany yesterday. Double-digit CPI in the Eurozone this morning. Euro weaker to 97.44. Crude lower by 1.3%, $80 and about 16 cents. That's the cross-asset price action about 15 seconds into this. Here's your movers. Here's Abby.
John, let's start out with one of the stocks that you were mentioning. Dig a little bit deeper. One of today's big stock stories, and that, of course, is Nike, down 12%. Its worst day since 2001. Absolutely plunging. This, of course, on that earnings miss, the gross margin miss having to do with bloated inventories, shipping costs, inventories up 44%. Plus, of course, foreign exchange. They also cut the fiscal year outlook. Gross margins about 200 bips worse than expected. So this stock really plunging. Apple is one reason why the futures and now stock market, the S&P 500 cash is actually down. Earlier in the pre-market, up 1%. Apple had also been higher, now down about 0.6%, heading to its worst week since June. This, of course, all driven by that U-turn on the production boost, down about 20% on the year. So a bear market right there. Still trading at 22 times the high end of the 5-year range. So this stock, even though it's down 20% on the year, is still expensive. Micron popping higher, up 0.8%. They have a supply glut, but apparently folks not caring, thinking that next year is going to be better. So interesting to see a supply glut for both Micron and for Nike, different industries, but similar problem. And then finally, Meta Platforms, it is up 0.6%, 0.7%, of course, in that hiring freeze, restructuring, the competition coming from TikTok, the economic outlook and environment weighing on ad spending. What's interesting about Meta right here, it's hitting on long-term support. It's trading at 9.7 times next year earnings, John. Some folks are going to start to look at this one as a bargain hunt.
Abby, thank you. Speaking of bargain hunts, Nike getting absolutely slammed, and I imagine a lot of inventory is going on sale. Just something to think about. Something to think about. Personally, just in case you... That's what I'm thinking of, Taylor. New sneakers, maybe. Tried to get the Brazil jersey for the World Cup later this year. Sold out already. There's going to be problems. I'm already anticipating it. The S&P down by about 0.1% on the S&P 500. Big tech wrapping up a really messy 3 months. With more, here's Ed.
Yeah, we're softer by 0.1% on the Nasdaq 100. A not bad end to what's been a horrible quarter, John. I think what's so staggering is this is the third straight quarterly decline on the Nasdaq 100. We haven't had a streak of quarterly declines like that since 2002. The biggest laggers in the quarter, some of the chip names so downtrodden, but also there's more speculative corners of the market, your Zooms and software stocks. What I find so staggering, let's bring up this next chart and just hover on it just for a minute. On August 15th, we were up 19%. On the Nasdaq 100. What changed? Well, the Fed on September 21st. What didn't change? Inflation and the direction of travel. And I'm really sorry, John, to end this quarter on a downer, but I'm going to do it. Is not great. We're resetting earnings expectations going into third quarter earnings where we expect more bad news. That list of names which account for a bulk of the market cap decline on the Nasdaq 100, we spent the last 3 years talking about how they're recession proof. But in a recession, earnings expectations get reset anywhere from 10 to 20%. It's not going to be good, John. And what improves it? No idea.
Don't apologise for it, Ed. You don't own it, sir. That's for sure. The S&P down by about 0.1%, 3 minutes into the session. I want to talk about Nike as well, down 12% in early trading. Nike and Micron really setting the stage for a pretty challenging earnings season. The latest results shedding light on the supply headwinds gripping corporate America this year. Taylor Riggs has more. Hey, Taylor.
Okay, away from the Nike running shoes, John, into the fundamentals of a balance sheet. Here we go. Take a look at Nike. And of course, the big number was the inventory. So on an overall headline number, inventory up 45% year over year. North America alone up 65%. Poonam Goyal yesterday, within 2 minutes of the press release, joins us on the call and says, yes, inventory is going to be the story. And it was unclear yesterday, I think, before the call, if it was just ordering ahead of time to get ahead of the holiday season, or if indeed it was more of a backlog. And I think we're learning today, not only on the call, but of course the price action today, that it really is just sort of a backlog of things that they need to cut prices, clear it out, and do a big reset for the holiday quarter. As you mentioned, I guess the good news for the consumers are the deflationary forces that come from uploaded inventory on the balance sheet. And so maybe we have that to look forward to. The street really looking for a big reset this morning as well. You know, Ed had sort of alluded to this. The tale of two stories is Micron. Also looking at some pricing issues when it comes to some of those memory chips and some big oversupply. But interestingly enough, the street actually okay with this because Micron comes out on the call and also says last night, first half of 2023 going to be weak, but looking for a big pickup in the second half of 2023. And so the street saying that actually they're going to be looking forward to that as well. And don't forget the CapEx big cut as well with Micron too.
Now back to the running shoes. You had a look, didn't you?
Okay, so I don't wear Nike marathon running shoes, but if there is a discount, I could be tempted.
You might have a little dabble. Have a look. Taylor, thank you. Just out of interest, what do you wear for marathon running?
Ooh, I do On Clouds. My race on Sunday.
Okay.
I'm wearing my Ons, so we'll see.
You're racing Sunday?
I am.
What's that in?
The another marathon.
Another
number
one?
14.
This number, really?
Yeah.
You've done, Taylor Riggs, good luck to you.
Thank you.
Thank you, as always. Investors bracing for a host of earnings downgrades now. A lot of results coming up over the next couple of weeks. Kelly has more. Hey, Kelly.
Hey, John, I'm just kind of distracted right now because I run like 3 miles max. So good for Taylor on that one. Now, as Taylor gears up to run a marathon, we are actually gearing up for earnings season because JP Morgan will be kicking things off just 2 weeks from today on October 14th. And we are expecting earnings will be much more slower in terms of growth than we saw in the second quarter. 3.1% is what is expected for the third quarter, but it is expected to pick back up at the end of this year and early in 2023. The question is whether those really accurately reflect what the reality might be. You've had a chorus of voices on Wall Street talking about how earnings expectations are still too high. All that said, they are moving lower steadily. So for 17 weeks in a row, we have seen downward earning revisions outpacing upward earning revisions. That is modeled there by the Citi Earnings Revision Index. And Nike, with its margin pressures, is a perfect example of what some of these strategists have been warning about. The idea that you have cost pressures on the one side and less of an ability to pass on those higher input costs to the end consumer when you have to do things like work down inventory and work with reduced demand. And another thing that the companies have to contend with in this environment is foreign exchange headwinds. The stronger dollar can be a big issue for big multinational companies that get a lot of their revenue overseas. And that is reflected in the market action we have seen so far this year. High international sales companies are underperforming those with no international sales. Those foreign exposed companies down about 25% on the year, John.
Kelly Lyons, awesome work as always. Kelly, thank you. Greg Peters of PGIM just writes in on the Bloomberg terminal just to let us all know he bought a new pair of Dunks. If you want to contact Greg Peters of PGIM, tell him congratulations. We're happy for you, Greg. I'm happy you got involved in the Nike sale as well. Joining us now, Bank of America's Jill Carey-Hall and Evercore's Julian Emanuel. Jill, you and Savita have been bearish for a while now. Have you seen enough pain yet?
Hi, John. Thanks for having me. Yeah, we've been targeting 3,600 on the S&P 500 for year end, so we're obviously much closer to that target. We're expecting a mild recession next year. I think if near term we see some more pain, there could be further downside risk to the market as earnings expectations, as was just mentioned, continue to come down. Those have been pretty sticky for the S&P 500. Consensus has still been looking for mid to high single digit earnings growth, 7 to 8% next year for the S&P, which we think is much too optimistic. So as those expectations continue to come down, market could remain volatile, sentiment could continue to deteriorate. If the recession's worse than expected, we've highlighted a floor of around 3,000 to 3,200 could be the worst case scenario on the S&P 500, but certainly getting closer to our target.
3K to 3,200. Julian, could it get that bad?
It could. Look, to us, the key is how the bond markets react. We all know that when you look at 2022, you can talk about earnings, you can talk about the micro, but the biggest story is the fact that the stock bond correlation has now flipped to positive after 25 years of risk on, risk off, and yields rising parabolically the last several weeks have dragged stocks down. We actually think this is an interesting time to step in and look at longer dated treasuries. But from an earnings perspective, we're looking for 0% year-on-year growth next year. We're below consensus for 2022 as well. So the risk certainly is downward in that respect.
Julian, let's pick up on that bond call. Said earlier this morning, the bonds don't work, they make things worse. Why are they a buy now?
Thinking about it this way, John, is on the short end, we know the Fed's resolute. We know the Bank of England has work to do on the short end. But yet at the long end, I think, again, they're likely to be tested, the Bank of England, again, perhaps next week, perhaps over the coming weeks. But there was a line in the sand drawn to preserve financial stability by bond buying. And obviously, we've seen that spill over into U.S. bonds as well. And from our point of view, if Ed Hyman's base case is 0% growth in 2023 and inflation break-evens are pretty darn close to 2% right now, that's a compelling case for long-dated bonds at these yields.
Let's take Hyman's growth number and send it over to B of A. Jill, where do we need to take down earnings expectations? And can you help me understand just a little bit more clearly how these big tech players will stand up to a major cyclical challenge without the fiscal transfers that consumers received and businesses were relieved by lower interest rates as well in the pandemic? How will they stand up to this cyclical challenge?
So we think earnings are slated to decline 8% next year. So earnings recession, not as bad as a typical earnings recession during an economic recession, assuming that this one will be mild. But we do see downside risk to earnings across the board, but particularly in some areas like consumer discretionary, where we think Margin expectations have been very elevated. Labor costs are the biggest cost for U.S. companies. Wages have remained high. So consumer has been one area we've been more cautious on. I think tech is another area that, investors could be too sanguine about, how defensive tech is since it held up well during COVID, obviously. But we've seen tech, especially parts of, communication services, remain extremely crowded by investors. Tech is not as defensive in our view as some might expect. I think, when you look at fundamentals, the NASDAQ and earnings revisions there have been, coming down relative to earnings revisions for the S&P 500. So, you're seeing that weakness fundamentally there. Growth stocks are still relatively expensive and over-owned relative to value stocks. So we've been market weight the tech sector and underweight communication services.
Julian, I'd love your thoughts on that, just how defensive the tech sector is on the S&P 500 in a world where you think this bond market could start rallying.
Yeah, Jill actually nailed it. The fact that the bond market could start rallying certainly does, at the increment, bode well for tech and growth. But the fact remains that these multiples are still high, particularly when you think about a rising yield environment generally at the short end, coupled with inflation, albeit starting to come down, still very high. And as Jill said, the fact is that professionals have been adjusting their weightings to growth over the course of this painful year, but the public still owns too much growth relative to the rest of their shareholdings, and that is certainly a headwind.
Can I get one buy from both of you? If you had to put some cash to work, and there's a lot of people watching right now that have put a lot of money into cash and out of stocks and out of bonds because everything's been so volatile in the last 3 months. Julian, if you had to put some cash to work in this stock market right now, where would you put it?
We think healthcare is very interesting here. The thing about the healthcare sector is, A, it's relatively inexpensive, and B, it tends over the long term to be much more immune to fluctuations in both interest rates and in currency, both of which are, the central eyes of this hurricane.
Jill, final word?
Yeah, we agree large cap healthcare looks interesting. I'd also say overweight U.S. domestic small caps. We're seeing a historic valuation gap between small and large cap equities. Small caps have been, much more adequately pricing in the risks around, U.S. economic recession, inflation, and they stand to benefit from some of the trends we're seeing. CapEx growth in the U.S. holding up very well. Companies might need to spend on CapEx more than they would during, if we are in an economic recession, given the need to automate. Wages are still high. Companies are reshoring manufacturing. So CapEx beneficiaries, domestic small caps, that's an area that we like.
I think we just did a whole market segment without talking about the UK. Liz Truss says thank you to both of you. Jill Carey-Hall, Julian Emanuel, to the both of you, thank you. What a week for everyone in this market. Equities down by about 0.2 on the S&P, the NASDAQ trying to squeeze out some gains. Coming up, a week marked by massive central bank intervention.
It's really important to step back and ask yourself, what has this week told us? It's been very sobering and we all feel exhausted, but we learned a lot.
Totally exhausted. That conversation up next.
We learned a lot. We learned that you can get a major policy slippage in the G7 countries with mature institutions. We've learned that liquidity can evaporate in mature markets just like that. We've learned that the most boring element of the non-banks can be a systemic risk. We've learned today inflation is still a problem in Europe and the US. And the last issue is what you just raised, this tension between monetary policy and financial stability. We need to absorb this.
Great to have Mohammed's guidance through the week so far. What a week it's been. Equities down just a little bit at the open on the S&P 500 by 0.5%. Data moments ago. With that data, here's Abby.
Indeed, John, and it's coming in as a miss. The Chicago PMI for the month of September coming in at 45.7 in contraction territory, below the previous reading and also below the expectation of 51.8. Interestingly, it's also below the overall U.S. PMI, which for the month of September, the preliminary number was 49.3. So Chicago doing worse. This is the worst PMI reading. Again, 45.7, deeply in contraction since 2020. Their economy, of course, lots of transportation, manufacturing, printing, publishing. When I think of Chicago right now, John, it's also, of course, moving Citadel down to Miami, making a $250 million donation, but that city in a bit of hurt. And again, that big move down by Citadel down into Miami. Different from this PMI, but nonetheless worse than the nation and in contraction.
We've seen a few of these regional Fed indicators look really, really soft. Seen a lot of that. Seen a lot of this. Volatile markets throughout the whole of this week, fueling, triggering some central bank intervention, leaving officials to grapple with how to curb financial risk while reining in prices. This coming as EU ministers race to contain an energy crisis amid double-digit inflation. Your team coverage starts right now with Bloomberg's Ed Harrison down in DC, Maria Tadeo in Brussels. Maria, walk me through what the EU has agreed on just at a time where Putin is making a series of headlines in the last hour.
The reality is, Jonathan, today we did not get anything new. That's the reality. And I'm surprised markets are reacting to this because everything they agreed today, this was a formality. Von der Leyen had already presented a lot of this 2 weeks ago. Remember, this was a windfall tax for European companies to separate potentially gas from electricity, the mandatory reduction when it comes to the use of energy. That is going to be key heading into the winter. The big question, and this is still the big unknown here, is will European countries agree on a cap on gas? And that is still unknown. We know that there's frustration, that there is a clash of views. There's a number of countries, 17 countries, by the way, I'm being told now, including the French, the Italians, the Spanish, the Belgians, who are pushing for this cap. But the Germans continue to say they worry about the disruption that it could create in the market flow. So not a lot was agreed today, but you see, and this is what's key to me, that verbal intervention from the Europeans actually does go a long way.
A week full of intervention. Ed Harrison, sum up this week for us. Intervention everywhere I look.
Yeah, I think so much intervention that you really wonder how much longer it can go on. It's not just what happened in the UK, but you know, just today we saw a record amount of dollar buying by the Bank of Korea because the won was under pressure. You know, we know that there's intervention in Japan as well. So the real question is how much more systemic risk can we take going forward? I think the numbers that came out today from the U.S. in terms of inflation, that came out yesterday in terms of consumption, suggests that the Fed has to keep on going. But the financial stability concerns are creeping in, and I think that we have hit peak hawkishness, and that means that the Fed will soon abate and go down to 50 basis points instead of 75.
Ed, earlier in this hour, I asked Mohamed Al-Arian whether this Fed would still be doing QT by the time we started 2023. What's your view on that?
Yeah, I think that it's going to be very tough, especially because that's where the liquidity concerns are. The liquidity concerns are most prevalent in the safe assets. I think that when you look at what happened in the UK, that's a warning sign to every single central bank in the world, especially here in the United States, where there's been reports, even from research out of the Fed, that there are liquidity concerns. The swaps market is getting very spooked. Those are signs that we're under stress and that people are seeking safe havens, and that market is not clearing in the way that it should.
What a week. How many times have I said that this morning? What a week. Edward Harrison down in DC, Maria Tadeo in Brussels. To the both of you, fantastic reporting, as always, here at Bloomberg. The S&P down 0.2, about 23 minutes into this. The NASDAQ basically unchanged, trying to squeeze out some gains. Up next, I'll bring you the trading diary and a sneak peek of next week. Closing out the month of September, and the third quarter as well. 25 minutes in, the S&P 500 totally unchanged so far. On the week, though, down on the week, down on the month, down on the quarter. We're down on the year. That's your equity market. That's the price action. Here's your trading diary. The UMich Consumer Sentiment Survey at the top of the hour. President Biden discussing recovery efforts for the hurricane at 11:30 Eastern Time. Plus, Fed speak continues throughout the day with Bauman, Barkin, Williams on deck. Looking ahead to next week, more Fed speak obviously kicking off on Monday. Plus, US manufacturing PMIs and ISM numbers. And then September 7th, got a payrolls report as well. I can tell you, just a sneak peek at a survey so far as we put that together for you. 250K is the median estimate at the moment for non-farm payrolls in America. Your previous number, 315. The actual number, about a week away. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.